Okay guys, so I want to talk about Sibanye Stillwater. Just came out with results, and some people are surprised that the first half is down by as much as it is, over 50%. The guidance I think was between 47 and 53% down in HEPS, and I'm pretty sure it's going to be on the low side of that. And you say, well, why? It's like perfect market conditions. You got Russia that isn't supplying platinum. There's been a shortage, first of all, of semiconductors. Combustible engines are perhaps in decline, but still plenty that are being produced globally. I mean, things haven't moved completely to EV, but there's more to the story. I mean, Sibanye isn't just about platinum. Remember, Sibanye brought out Stillwater in America. They brought out Lonmin here in South Africa. And when Sibanye came to market, they were basically given assets by Goldfields. But the life of mines of those assets were not very long. The longest was about 7 years. Some of those existing life of mines have now just been extended maybe another year or so. But basically, there's assets that have got 2 or 3 years left before their life of mine is completely expired. So now, what Froneman is very good at is extracting value from end-of-life assets, being able to go a little bit deeper than everybody else. But of course, there's risk when you're in such deep mines. There's risk when you're trying to extract that last little drop. And so you may, as a result though, get very good cash flows for 2 or 3 years. But if you invest and maybe you're new to investing, you're not too familiar with the discounted cash flow model, but essentially on a discounted cash flow model, you don't want to just look at 2 or 3 years. You'd be shooting yourself in the foot if you're going to do an analysis of a company that's only got cash flow that you can predict for a very short period of time, and thereafter there's nothing. Then what you're doing is you're buying the promises of the management team. And so this is even more of a problem when you're investing in a new project where there's maybe a pre-feasibility study or a feasibility study that you're relying on. And so I think the lesson to be learned here is when Sibanye came out with results earlier this year, the share price rallied up nicely. All of those guys that were holding Sibanye in the competition were obviously very happy to see the share price rally from the 40 Rand level all the way up to about 78. I mean, it was nearly doubled in a short period of time. And now it's right back below 40 Rand again. When it was 78 Rand, watch what the insiders are doing. The insiders were selling. They would have given you reasons that they were paying down tax, whatever it may be. But there's always more to the story. Sometimes the story isn't in the annual financial statement. Sometimes the story isn't in the cash flow statement even. Sometimes the story is in those other little sense announcements that are not in the clearly disclosed. So the day before the announcements came out, there was a life of mine disclosure, which all miners have to give. And that life of mine disclosure just like made me think this share is probably worth 16 or 17 Rand. I mean, I just don't get the multiple. Till they buy something and we know what they're going to pay for it and what that's actually worth, Sibanye wasn't worth anything in my mind. Or wasn't worth more than that sort of region. Certainly not 80 Rand a share. So nevertheless, the market believes what it believes because it looks at very low PEs. And again, I re-emphasize, and it goes back to my video from yesterday, view it if you haven't seen it, that you have to understand the full commodity cycle, the life of mine. You can't just look at earnings and dividend yield, because remember when Froneman came to market with Sibanye, he sold a fantastic story. It wasn't the usual thing for gold mines to pay dividends, and here he was generating cash and he could give a fantastic dividend yield of 7 or 8%, which the market really enjoyed at the time. Remember, interest rates globally were going down and we were expecting South African interest rates to go down, and here you're getting a company that looks like it's got great cash flow and is returning a lot of cash to shareholders. On that note, just remember, together, same situation. Don't buy a mine just because of dividends. That's not what mining is about. Look at the cash flow stream over a consistent period of time, 10 years, and you've got to know that you can trust management. So even now, if you're buying into a story where there's a scarce commodity and the directors are telling you, gee, we've got like 10 times more than anybody else in the world, we like set up, and yet some investors are doing their due diligence and they're not putting up the money, you've got to raise some question marks and think about it. So coming back to what I said in my very first video about Neil Froneman, what is the actual story there? Some people might not know. So Froneman was part of Brett Kebble's empire. Eventually he got to run Afrikaner Leases. Afrikaner Leases was a favorite gold miner. But what's interesting about gold, if you're mining gold, the residual, there will always be some uranium. Sometimes those uranium deposits are rich, sometimes they're not very rich at all. Now, Dominion Mines, or the Dominion ore body, whatever you want to call it, was analyzed by Anglo American, and they found that it was not economical. Yet Froneman decided, no, I'm going to take this and I'm going to create uranium-1. At that time, the JSE code was UUU. I think AFLEAS may have done the original feasibility or pre-feasibility study, I'm not too sure. But suddenly he came out, and the geologists came out, to be fair, and said, yeah, there's a fantastically rich uranium deposit. And uranium prices were going up. So, you know, when helium goes up, when uranium goes up, when coal goes up, everybody wants to be in those sectors. So just think about that for a minute. If you've got a commodity cycle that's an abnormally high price, and people are coming to market telling you, listen, I've got this and I'm looking to raise funds so that we can extract it, immediately you should be asking a few extra questions, because that's what guys want to do. Banks aren't always going to ask the questions. They're going to look at the geology report, they're going to chat to management, they're going to make a decision. Banks are interested in earning interest on their money, and if they think there's a likelihood that they're going to get that money back, they're happy to lend it to you and make their margin. So just keep that in mind. So going back to the history of Neil Froneman, and this is why I say the character of the individual is so important. So Uranium-1 came to market with this fantastically rich Dominion uranium deposit, and eventually, come 2008, there's these crown jewels of Uranium-1 needed to be written off. By then, Froneman had sold a lot of his shares. He had extracted fantastic salaries through the company and bonuses, but spending nearly 1.8 billion in mostly equipment to get the uranium deposits, this was all just written off down to about $50 million in 2008. Of course, shareholders that were still left holding UUU, which also was almost a 10-bagger. In fact, if memory serves me right, it might have been a 10-bagger. It was one of those crazily high share prices. And at the time, I was also very skeptical. Wasn't buying into the full story. And for many, many months, Uranium-1 just carried on being the darling. Gold-1 span off. There's actually quite a lot of history in terms of where Uranium-1 is today, even with the Clinton Foundation having sold Uranium-1 to the Russians. But that's a story for another day. But coming back to the Froneman's issue, so yeah, he's telling the market, great, he's able to raise lots of funds. Many of those funds, and that came from either shareholders or from banks, would have been used to pay bonuses, to declare dividends, and whether he sold all his shares or not by the time it collapsed is irrelevant. Anyway, in 2010, Oak Bay buy this Dominion mine, again on some feasibility study of how rich the uranium deposits are, and they create SIVA resources, which ends up being worth nothing eventually anyway. We know the Guptas, the story of the Guptas, the control in South Africa, and specifically how they tried to extract wealth. Well, what happened is, because they created SIVA, they had feasibility studies, they went to the IDC, Industrial Development Corporation, and were able to secure loans. They were able to secure some funding from shareholders that were duped, mostly the retail public. And this is the modus operandi of many mining magnates. So just be very, very careful on the stories that you buy, not only just in mining, but in other industries as well. And so again, I'm emphasizing that it should not have been a surprise that Sibanye now produce results where their earnings are 50% down purely because of the life of mines. Yes, they have had a few issues in terms of safety, stoppages, closures, strikes, incidental accidents, problems that maybe they couldn't have foresawn. But remember, there's a lot more risk in these mines. It doesn't matter that Neil Froneman paid himself a bonus of 300 million rand this year. And again, that comes back to my social part of the ESG. Look at how much executives are paying themselves, how much bonuses they're getting, how many shares they hold, how many shares they're selling, and think about, why are they actually involved in this business in the first place? What are they getting out of it? And should you be following them? Because they're the selling shareholders and you're the buyer. You're buying their story. I also think about Froneman's promise of going into green metals. Obviously, that's the story that he has to tell. But actions speak louder than words. What has he actually purchased? What he has done is he has managed to secure funding of $1 billion on the basis that he was going to buy something, which he then walked away from and gave the market what was his reasons, or their reasons as a board, for not purchasing it. I worry a little bit about it. Froneman's son used to be part of Stillwater, and he's just now recently left for whatever reasons to pursue his own means. But all these little things should make you start questioning the soundness of a company like Sibanye. At the same time, I'm saying, think about Thungela. Thungela doesn't have a track record. It hasn't even been listed for a year. Just like Gold Fields almost gave Sibanye's assets to Neil Froneman for just about nothing. They walked away with very little. Do you think that Anglo American would give the coal assets to Thungela Resources for almost nothing? They held on to 8 or 9% of those assets. And then after the first dividend was declared in March of 2020, after the share price had ran up to what they probably thought was above fair value of about 150 Rand a share, they sold out. They took their profits, don't own any more Thungela Resources. Do you really think that if the coal price was around 85 to 150 US dollars, that Thungela would be making anything like these kind of profits at the moment? Obviously not. You know what big miners, diversified like Anglo American, and bigger miners like Gold Fields, who could end up being the third biggest gold mine in the world shortly, they know that there's a cost of cleanup. When it comes to the end of life of mine, that's the time to get out. Especially in coal, you don't want to be paying the communities and environmental fees and things for cleaning up the mess after mining. Mining does an immense amount of destruction. However, opportunistic miners will find ways to pick up these assets for just about nothing, extract the 3 or 4 years of cash flow out, and because their shares are at such a low multiple, it can assist them in either purchasing other assets for paper by merging, and those other assets might also be assets that have a very little or short lifespan left. I guess the main lesson is probably something that Peter Lynch subscribed to. And he said if you're going to invest in something, and I suppose Warren Buffett to a degree as well, most value investors, if you're going to invest in something, then you need to understand what you're investing in. And right now, I think we're in a cycle where growth will probably lose a bit of favor. People will look at valuations again, and make sure that you don't buy something because it's on a low PE if you don't understand it. You're going to have cyclical companies on PEs of 4 or 5, or companies where the growth is in decline. But what you want is growth at a reasonable price. Value where you know you're going to still get growth going forward, where you can work out the discounted cash flow over the next 10 years with a degree of certainty, a degree of confidence. And if you don't understand mining, you don't understand coal mining, you don't understand gold, please don't invest a lot of money in these things. It's purely speculative if you don't understand it. And so, not to be arrogant, I just think that a lot of the commentary that I was hearing about Sibanye and a lot of the positivity was based on historic multiples of earnings, on the dividend yield. These are very superficial ways of looking at companies. You need to understand the future earnings, because the market, if it's rating a company on such a low PE and such a low dividend yield, it's usually for a reason. It's usually because it's not expecting future earnings to be that great. Of course, there are exceptions, and sometimes the market gets it wrong in terms of a company that's grown for 20 or 25 years, that they're expecting that growth to continue. It doesn't always work like that. So until there's a shock to the market, or until they realize that those forecasts have changed, the share might continue to be on high multiples. But you're not going to find the real growth companies on multiples of 4 or 5. So just keep that in mind. If you're finding a share that's on a multiple of 4 or 5 and a high dividend yield, you need to understand the reason for that. And if you think that the market's got it wrong, great, go out and buy it. But don't just buy it if you haven't actually done your homework. Thanks for watching. Please subscribe. Look forward to chatting to you again tomorrow.